So in the second quarter of 2026, Lennox International did something that honestly you almost never see in the corporate world.
No, you really don't.
Right. I mean, they intentionally fired a massive chunk of their own new residential customer base.
Just walked away.
Exactly. They looked at basically 30% of the home builders and contractors in one of their main distribution channels and just completely walked away from the contracts.
Yeah, they actively chose to shrink their own top-line revenue.
Which is crazy, right?
Yeah.
And Wall Street, surprisingly, they didn't really punish them for it.
Not like you'd expect, anyway.
Right. So today we are unpacking why walking away from sales like that might actually be, well, the ultimate flex of corporate pricing power.
It's a huge flex.
Welcome to this Stock Ticker's Deep Dive. I mean, if you were a retail investor holding industrial or HVAC stocks, or, you're just trying to figure out how to value a company that seems to be operating in two completely different economic realities at the exact same time, you're definitely in the right place. We are breaking down the Q2 2026 earnings call for Lennox International Inc. So that's ticker symbol LII.
LII, yeah.
And our source material today is the raw transcript. We've got CEO Alok Miskara and CFO Michael Quenzer. And per the Talk Tickers format, we are going heavily data forward.
Stripping out all the corporate spin.
Exactly. We're translating the jargon, we're taking a definitive stance on the underlying fundamentals, and we're filtering all of it down to actionable portfolio insights for you.
Yeah, and the Lennox situation right now, I mean, it is the textbook definition of a split personality balance sheet.
Split personality, I like that.
Well, it is.
Yeah.
Because we often look at companies as, these monolithic entities where the macro environment just kind of lifts or lowers all the divisions equally.
The rising tide lifts all boats, kind of.
Right, exactly. But the data from this Q2 call, it just completely shatters that assumption. You have half of this business fighting severe macroeconomic gravity, while the other half is absolutely obliterating its growth targets.
It's wild.
It really challenges the standard models we use to price industrial equities.
It does. And the performance gap is just glaring when you put the Q2 numbers side by side. So Lennox operates on two main engines, right?
Right. The residential and the commercial.
Yeah. So first you have Home Comfort Solutions. They abbreviate that as HCS. That is the residential business, so handling the heat pumps and air conditioners for single-family homes.
The stuff in your backyard.
Exactly.
Yeah.
And then you have Building Climate Solutions, or BCS. And that's handling the massive $1 million commercial HVAC units for hospitals, data centers, big box retailers.
Heavy duty stuff.
The heavy duty stuff. So looking at the residential side, HCS, it took a serious beating. Revenue declined 7% year over year.
Yeah, 7%.
But, and this is key, that 7% top line number is actually heavily engineered.
Oh, incredibly engineered.
Because the actual physical unit volumes, the amount of metal boxes they actually shipped out the factory doors, that dropped by a steep 12%.
12% fewer units, that's a lot.
It's huge. And they only kept the revenue drop to 7% by basically pushing through a 3% boost in pricing and product mix. And then they padded the rest with a 2% bump from recent acquisitions.
Right. And even with those pricing offsets, and the M&A padding, the residential segment still bled $30 million in profit.
$30 million.
Yeah, because a 12% reduction in physical throughput, it isn't just a sales problem. It creates this cascading operational failure across the manufacturing footprint.
How so?
Well, when we evaluate heavy industrial stocks, volume is essentially the lifeblood of margin.
Right, because of the operating leverage involved.
Exactly.
And the CFO, Michael Quenzer, he actually quantified this on the call. He cited roughly $10 million in what he called factory absorption headwinds.
Right, the absorption penalty.
Yeah, and that was specifically tied to the lower residential production levels.
Yeah.
So for the retail investors tracking the manufacturing sector, I think this is a crucial mechanism to translate. Right?
Oh, absolutely. It's vital.
Because we aren't talking about variable costs here. Lennox operates these massive capital-intensive assembly lines.
Yeah, you have enormous fixed overhead. I mean, the lease on the facility, the depreciation on the heavy machinery, the baseline union contracts, the electricity just required to keep the plant operational.
Oh, lights have to stay on.
Exactly. And those fixed costs, they remain static whether you manufacture 10,000 heat pumps or 10.
Right. So when residential unit volume plummets by 12%, you are spreading that same massive fixed cost burden over a significantly smaller number of units.
Right. So the cost to produce each individual air conditioner artificially spikes.
Exactly. So that $10 million absorption penalty is just the direct mechanical consequence of intentionally slowing down the assembly line.
And they did slow it down on purpose. I mean, management is actively throttling production to align their inventory levels with the deteriorating market demand.
Because what's the alternative?
Well, the alternative is running the factories at 100% capacity just to maintain that cost per unit efficiency.
Which sounds good until you think about it.
Right, because that would mean flooding their distribution centers with unsold inventory. You'd be trapping hundreds of millions of dollars in working capital inside these metal boxes that are just gathering dust.
Which would be totally catastrophic for the balance sheet.
Exactly. So taking the $10 million hit to the income statement to protect the cash flow statement, it's really the lesser of two evils.
It makes sense. And if we look at the commercial segment, BCS, the picture just violently reverses.
It's night and day.
It is. Commercial revenue surged 24%.
24%.
Yeah. And more importantly, 12% of that was pure organic sales growth.
Meaning it wasn't bought through M&A.
Right. That is pure organic market share capture in an environment where, let's be honest, overall commercial real estate construction is certainly not growing at 12%.
No, definitely not. And the contrast is so stark. It really forces you to reevaluate the core thesis of the stock.
What do you mean?
Well, when you have one division shrinking by 12% in volume and bleeding profit, and another growing 24% and expanding margins, the blended enterprise numbers just become incredibly muddy.
Right. The average hides the extremes.
Exactly. The retail investor cannot just look at the consolidated EPS and make a quick judgment. You have to isolate the cash flow to find the actual heartbeat of the enterprise.
And the cash flow is where the panic over that residential bloodbath should probably subside, honestly.
Yeah, I agree.
Because despite the $30 million segment profit drop in residential, Lennox generated $172 million in operating cash flow in the second quarter.
That's a massive number.
It is. They also reported a 92% conversion rate on their trailing 12-month free cash flow.
Which indicates just a relentless focus on working capital management.
Right.
I mean, they are aggressively pulling in receivables and stretching payables just to offset the margin squeeze on the factory floor.
Yeah, and they're also telegraphing immense confidence in that cash generation. Like, they repurchased $130 million in shares during the quarter.
Right, which is fascinating. Typically, when an industrial CEO sees a 12% volume drop in their primary consumer business, the immediate reaction is capital preservation.
Hunker down.
Yeah, you freeze the buybacks, you hoard the cash, and you prepare for a prolonged winter.
Right.
So deploying $130 million into their own equity at this specific moment, it suggests management strongly believes the market is mispricing the long-term value of that commercial growth.
While simultaneously overpunishing them for the temporary residential weakness.
Exactly. It's a calculated flex.
A huge flex. But to really understand why they are so confident, we have to look at the why behind that 12% residential volume drop.
Intentional drop.
Right. Because going into this transcript, I think the easy assumption was that the macroeconomic environment simply crushed them.
Sure. Mortgage rates are high. Existing home sales are basically frozen.
Yeah. So naturally, people aren't buying air conditioners. But during the Q&A, analyst Ryan Merkel challenged Alok Miskara on the direct-to-dealer channel, and Miskara revealed this fascinating strategic pivot.
Oh, this was the highlight of the call.
It really was. The 12% overall drop was heavily driven by an intentional 30% reduction in their one-step distribution channel.
And that's specifically tied to residential new construction, or RNC.
Yes, RNC. So they didn't just lose this business to competitors, they actively chose to walk away from it.
Which runs completely counter to the traditional Wall Street playbook, right?
Yeah.
One that prioritizes market share and top-line revenue above almost everything else.
Growth at all costs.
Exactly. But the residential new construction market, it is dominated by large corporate home builders who wield just tremendous negotiating leverage over suppliers.
Because they're buying in huge bulk.
Right. And in a softening housing market, those builders, they squeeze the HVAC manufacturers for every possible cent. It turns the contracts into a brutal race to the bottom.
It's the total commoditization of the product.
Yeah.
The builder doesn't care about the advanced variable speed compressor technology or the brand prestige of a Lennox unit. They just care about shaving $200 off the build cost of the house.
That's all that matters to them.
Right. So Miskara realized that continuing to compete for those specific R&C contracts meant accepting low margin or even negative margin business.
Yeah, and he delivered a rather iconic quote on the call about this.
Oh, I love this quote.
He stated that Lennox refuses to, quote, fall victim of taping $100 bills to every unit that is being shipped out.
It's such a great image because that imagery perfectly captures the absurdity of negative margin volume.
It really does. When you are operating in a highly competitive, capital-intensive industry, chasing unprofitable market share destroys shareholder value faster than almost any other strategic error.
You're literally paying people to take your product.
Exactly. And another analyst on the call, Dean Dre, he tried to determine if Lennox had quietly changed their internal return on invested capital requirements.
Like, did they raise the bar too high?
Right, basically asking if they had set the hurdle so high that their sales teams couldn't clear it. But Miskara pushed back firmly.
Yeah, he said the internal return requirements haven't changed in 5 years.
Right. What changed was the irrational pricing behavior of their competitors in the new construction space.
Meaning the competitors are willing to take the loss just to keep their factories humming.
To avoid those absorption headwinds we just talked about.
Ah, right. But Lennox is taking the opposite approach. They are accepting the short-term factory inefficiency penalty to protect their long-term brand equity and their pricing power.
Because if you start selling your premium units at basement commodity prices to home builders, your existing retail network, like the independent dealers who sell high-margin replacement units directly to homeowners, they're going to demand the exact same massive discounts.
Right. You cannibalize your own pricing structure.
Exactly. It is an aggressive high grading of the customer base. They are basically flushing the toxic revenue out of the system.
And that requires a management team that is structurally insulated enough to endure the inevitable quarterly earnings misses without panicking.
Yes. They're prioritizing the integrity of the profit margin over the vanity of the revenue line.
Which brings us back to the commercial side of the ledger. Because that 24% growth in BCS, it's largely built on a very specific, highly lucrative subsegment, right?
Right. Emergency replacement.
Yeah, the transcript highlighted this as a massive growth driver. And the logistics of commercial emergency replacement explain exactly why Lennox is capturing so much margin here.
It's a totally different dynamic than residential.
It really is. Like, think about it. If a homeowner's AC dies in July, they might suffer for a week, buy a cheap window unit, and get 3 competitive bids from local contractors.
Right. The homeowner is highly price sensitive, and they're willing to trade time for cost savings.
Exactly. But the commercial client does not have that luxury.
No luxury at all. I mean, if a 50-ton rooftop chiller fails at a pharmaceutical manufacturing facility or, a regional data center, the financial loss per hour is staggering.
Right, millions of dollars.
Yeah, so price sensitivity just evaporates immediately. The only metric the facility manager cares about is execution speed.
Who can fix it the fastest?
Exactly. The manufacturer who can source the specific unit, dispatch the crane, and execute the installation in the shortest possible window, they win the contract.
It becomes a logistics play rather than a pricing war.
100%. And Lennox has spent the last 2 years completely reconfiguring their supply chain specifically to dominate this critical window.
Yeah, they highlighted extra capacity coming online from a new factory alongside strategic space they freed up in their Stuttgart facility.
Which is brilliant. They are pre-positioning inventory in regional hubs so they don't have to manufacture these massive units on demand.
They just have to deploy them.
Right. And because the urgency is so high, the gross margins on these emergency replacements are phenomenal.
So they're subsidizing the residential contraction by absolutely dominating the highest margin niche in the commercial space.
Yes, although there is a significant piece of accounting noise in this quarter that artificially pads those margins.
Oh, right, the tariffs.
Yeah, it requires careful dissection. The CFO disclosed a $30 million benefit from tariff refunds.
$30 million.
And that hit the product cost line much earlier in the year than they internally modeled.
Yeah, the breakdown was $25 million dropping straight into the residential segment profit and $5 million into the commercial segment.
Right. And when a $30 million windfall lands in a single 90-day window, It heavily distorts the underlying operational performance.
It makes the quarter look artificially great.
Yeah, and analyst Chris Snyder actually pushed management on this. He questioned whether the market should mentally strip that $25 million out of the residential profit pool just to calculate the true organic margin run rate.
Which is a very fair question. But Miskara's defense was interesting. It was grounded entirely in pricing strategy.
Right. He argued that the tariffs and the anticipated refunds of those tariffs are inextricably linked to their pricing models.
Basically saying, if they hadn't secured the $30 million refund from the government, they would have just passed that exact cost onto the consumer via price hikes.
Right. So you cannot just back out the benefit without also modeling the alternative pricing scenario.
It's a fair defense of their pricing power, sure. But the secondary impact of these tariffs is where the real operational friction lies, I think.
Oh, absolutely.
Because later in the transcript, management admitted they actually had to cut their expectations for internal cost productivity.
Yes.
And the reason? The sheer bureaucratic complexity of navigating trade regulations across the US, Mexico, and Canada.
Right.
It essentially forced Lennox to pull their top engineers off of core margin improvement projects.
Which is just a textbook example of hidden corporate friction.
It really is.
I mean, you have highly compensated industrial engineers whose actual mandate is to redesign a heat pump chassis to require 5% less raw material, or, to streamline a wiring harness to save 3 minutes on the assembly line.
Right, doing real engineering work.
Yes, but instead, those engineers are essentially performing international trade compliance auditing.
Which is absurd.
It is. They are literally mapping the country of origin for individual subcomponents just to satisfy customs regulations.
So the $30 million refund looks fantastic on the Q2 income statement, sure.
Looks great on paper.
Right. But the administrative burden required to claw that money back from the government actively cannibalized their future efficiency roadmap.
Exactly. It delayed internal cost reduction initiatives that would have provided permanent margin expansion rather than just a one-time cash injection.
It really perfectly illustrates how macro trade policy physically disrupts the innovation cycle on the factory floor.
It does. Which I think forces us to look forward. We've dissected the mechanics of Q2, but the management guidance for the back half of 2026 presents a much more complicated thesis for the retail investor.
Yeah, they executed a massive reshuffling of their forward expectations.
It's a total reshuffle.
They took a hatchet to several key metrics. So let's start with the bottom line. Full year adjusted earnings per share was revised downward to a range of $23 to $24.
Right. And directly tying back to those distracted engineers we were just talking about, the company's internal productivity expectation for the year was slashed by 20%.
20%?
Yeah. They originally modeled $75 million in cost savings. They are now gunning for just $60 million.
So that is $15 million in structural operational efficiency that simply vanished from the 2026 roadmap.
Just gone. Due to the absorption headwinds and the trade compliance distractions?
Right. But the revenue guidance is where the math gets incredibly aggressive.
This is the craziest part.
It really is.
Yeah.
Management kept the overall enterprise revenue growth target anchored at roughly 8%.
Unchanged.
But to hold that consolidated number steady, they had to radically alter the internal mix.
Yes. The divergence we saw in Q2 is basically being extrapolated through the rest of the year.
Right. So they previously expected the residential side, HCS, to grow by 4% in 2026.
Right.
They have now gutted that expectation down to a mere 1%.
What, 4 to 1?
Yeah. And to prevent the overall company revenue from collapsing because of that, they took the commercial side, BCS, which was already modeling a highly ambitious 16% growth rate, and they cranked it up to 20%.
20% growth. I mean, they are entirely reliant on the commercial segment operating flawlessly just to mask the residential deterioration.
Flawlessly.
But the most critical detail for the retail investor is actually hidden inside that 1% residential growth target.
Yes, because that is not organic growth.
Not even close.
Right as the quarter closed, Lennox finalized a significant bolt-on acquisition, taking down the Comfort Air, Century, and Coast Air brands.
Right.
And they financed this by levering up with roughly $200 million in debt.
Which is a classic middle market consolidation play, buying up regional distribution footprints just to force their products through new channels.
Exactly. But the CFO explicitly disclosed the mathematical impact of this M&A on the current year's guidance.
Right. This is where you have to read the fine print.
You do. The acquisition is artificially adding about 1% to the total enterprise revenue and a highly consequential 2% specifically to the residential segment's revenue.
So this is where you really have to do the math yourself because the headline is totally deceptive.
Yep.
If you strip out the revenue they literally just purchased with $200 million of borrowed money, the core organic residential business is fundamentally shrinking.
Right, because a 1% growth target minus the 2% M&A padding means the legacy residential volume is actually operating at a negative 1% run rate.
Negative 1%. The debt-fueled acquisition is mathematically obfuscating a real contraction in their core consumer market.
It's masking the pain. So if you are an investor building a thesis on Lennox, this is the exact moment you have to critically evaluate the risk profile.
Absolutely.
You have a management team cutting EPS guidance. They are accepting $10 million in quarterly factory inefficiencies. They're losing $15 million in projected productivity savings to bureaucratic distractions. And they're using leverage to buy revenue that masks an organic contraction in their largest segment.
It's a lot of red flags.
Yeah, it is. I mean, a traditional momentum investor would look at that stack of data points and immediately liquidate the position.
Oh, without hesitation.
Right. So let's run with that bearish scenario for a second. If I am an institutional short seller or just a highly skeptical retail investor, I'm looking at this transcript and seeing a massive problem. The consumer is clearly tapped out. Mortgage rates are suppressing the housing turnover that traditionally drives HVAC upgrades. If you are masking organic negative growth with debt, right as the consumer cycle rolls over, you are incredibly vulnerable to a severe multiple compression.
It's a very valid bear case.
So why shouldn't Wall Street punish this stock right now? Like, what is the counter argument that prevents a mass exodus of capital?
The counter argument is entirely rooted in the balance sheet and the free cash flow profile.
Okay, unpack that.
Well, the income statement is currently absorbing a tremendous amount of cyclical friction, right?
Yeah.
But the underlying cash generation engine is shockingly resilient. Despite slashing EPS, cutting productivity, and shifting the whole revenue mix, management held their full-year free cash flow guidance absolutely rigid at $750 million to $850 million.
They didn't budge a single dollar on the cash flow projection.
Not $1, because free cash flow cannot be easily manipulated by accounting adjustments or M&A padding.
It's the truth serum of the business.
Exactly. It is the raw capital generated by the enterprise. And they are securing that $750 million floor through draconian working capital management.
Like draining inventory.
Yes. The CFO noted that unit inventory levels declined again in the quarter. They are aggressively draining the working capital out of their warehouses and turning it back into liquid cash.
Right.
Furthermore, look at the capital structure even after that $200 million debt injection.
Right, because their net debt to adjusted EBITDA ratio is sitting at just 1.3 times.
Which is absurdly low. In the heavy industrial sector, operating at 1.3 times leverage is practically a fortress balance sheet.
What's the industry average right now?
I mean, many of their peers in the manufacturing space are perfectly comfortable running at 2.5 to 3 times leverage.
Wow.
Yeah, so Lennox has immense untapped debt capacity. They are generating $750 million in free cash flow. They have minimal leverage, and they are using that precise structural advantage to execute share buybacks at depressed valuations.
And acquire regional competitors like Comfort Air, while the cost of capital is elevated for everyone else.
Exactly. They are weaponizing their balance sheet during a cyclical downturn.
Weaponizing the balance sheet.
Yeah. While the smaller, over-leveraged HVAC distributors are struggling just to service their debt in this rate environment, Lennox drops $200 million to buy up Comfort Air and Coast Air, expanding their geographic footprint when assets are relatively cheap.
So it's a defensive income statement paired with a highly offensive balance sheet strategy.
Perfectly said. Synthesizing the entirety of this transcript, the investment posture really becomes clear, but the verdict requires you to bifurcate your time horizon.
Okay.
Long-term, the structural discipline demonstrated here is highly bullish. Near-term, however, the residential reality remains overtly bearish.
So let's make this actionable. For the listener currently holding LII in their portfolio, the data suggests staying the course.
I would say so.
Because the 12% residential volume drop is alarming on the surface. But the context, intentionally high-grading the customer base by firing unprofitable home builders that proves management is protecting long-term return on invested capital.
Right. They are enduring the immediate pain of factory absorption headwinds rather than destroying their brand equity with commodity pricing.
Yeah, you combine that discipline with a commercial segment organically growing at 12% with massive incremental margins, and the underlying business is incredibly sound.
Very sound. The dividend is heavily protected by the cash flow, and the buybacks basically provide a floor for the equity.
Right. But the calculation shifts entirely if you are looking to initiate a new position.
Yes, totally a different story.
If you are stalking the stock, waiting for an entry point, patience is the optimal strategy right now.
Definitely.
Because CEO Alok Miskara explicitly stated that the residential demand recovery is materializing much slower than anticipated.
Yeah, the consumer confidence data is a massive headwind.
Huge headwind.
Inflation fatigue and elevated financing costs mean homeowners are actively deferring large capital expenditures.
And in the Q&A, analyst Jeff Hammond actually probed this repair versus replace dynamic.
Oh, this was a great exchange.
It was. He was trying to gauge if consumers were finally capitulating and buying new systems.
Right.
And Miskara confirmed that while the trend may have stabilized somewhat, the channel confidence remains incredibly fragile. Local HVAC contractors are being forced to run heavy promotional discounts just to convince homeowners to pull the trigger.
Yeah, and management is lowering the residential guidance precisely because they keep modeling a consumer recovery that just fails to materialize.
So until there is definitive macroeconomic evidence that the housing turnover cycle has bottomed and consumer credit is expanding, stepping in front of this residential contraction is unnecessarily risky.
Exactly. You are buying a highly profitable commercial business that is currently changed to a very heavy consumer anchor.
Which actually sets up one of the most fascinating forward-looking dynamics in the industrial sector right now.
Yeah, I love this part of the thesis.
Right. If we pull on the thread of that repair versus replace behavior, it reveals a massive hidden catalyst for this stock over a multi-year horizon.
It does.
Because homeowners are currently choosing to spend, say, $600 fixing a failing blower motor on a 15-year-old air conditioner rather than financing an $8,000 replacement.
Right.
They are applying temporary band-aids to aging infrastructure because they feel cash-strapped today.
And this is the critical distinction between demand destruction and demand deferral.
Expand on that.
Well, if a consumer decides not to buy a new television this year, that sale is permanently destroyed. You don't buy 2 TVs next year to make up for it.
Right, it's just gone.
But an HVAC system is critical infrastructure with a terminal physical lifespan.
It will eventually die.
It has to. You can only patch a rusting condenser coil for so long before the entire system suffers a catastrophic, unrepairable failure.
And that's where the math gets really interesting for Lennox. Because the 12% drop in their residential unit volume represents millions of consumers pushing their existing equipment past its engineered lifespan simultaneously.
Millions of them.
It is mathematically creating a synchronized wave of future failures.
Yes.
So what happens in 2027 or 2028 when all of those Band-Aids inevitably fail at the exact same time?
It forces a massive wave of emergency residential replacements.
Right.
And as we analyzed with the commercial sector earlier, the moment a replacement becomes an emergency when it is 100 degrees in July and the compressor just permanently seizes consumer price sensitivity, immediately drops to near zero.
They don't care what it costs. They just want cold air.
Exactly. They no longer have the luxury of shopping around for 3 weeks. They accept whatever price the first available contractor quotes them.
So the deferral cycle is actively building a coiled spring of demand.
A massive coiled spring.
Today's severe volume contraction and the margin pressure is the exact mechanism guaranteeing unprecedented pricing power for the manufacturers in the future.
Yep. The longer the consumer delays the replacement, the more violent the eventual snapback in volume will be.
Which is wild to think about.
It is. But evaluating Lennox requires looking past the localized pain of a single quarter's absorption headwinds. The commercial business is funding the enterprise today, while the residential market builds this deferred pressure for tomorrow.
And when that replacement cycle finally breaks, the operational leverage that is currently penalizing them on the factory floor,
it will violently reverse in their favor, driving explosive margin expansion.
It's just a totally different way to look at a bad quarter. And this is exactly why you have to strip away the headline numbers and read the actual transcript.
You really do.
You have to understand the mechanics of factory absorption, the strategic value of walking away from bad revenue, and the difference between destroyed demand and deferred demand.
Those nuances are everything.
They are. Well, we hope this deep dive into Lennox International provided you with a clearer framework for valuing complex industrial operations.
Keep tracking the free cash flow.
Yes. Watch the inventory levels and pay close attention to how these management teams allocate capital when the macro environment turns against them. We will see you on the next Talk Tickers analysis.